Okay, this presentation on the evolution of private equity in emerging markets is based on a teach-in seminar that I led at UNC's Alternative Investments Conference in March of 2018. Now, emerging markets private equity, or EMPE, is fairly unloved as of late, for good reasons, as I'll argue in this presentation. But I also think that a closer examination of trends within the asset class suggests that this is actually one of the few places where scarcity exists in a world that is awash in capital. But first, before I begin, real quick, a disclaimer. This is for informational purposes only, not investment advice. All right, so before we begin our journey, I thought it'd be helpful to have some context on EMPE. And the truth is that this is a fairly niche area. Emerging markets private equity is a tiny portion of global activity, as you can see in the orange segments here. And that's true whether you measure it by the volume of fundraising or by investment. And if you exclude the years 2010 and 2011, when you had a denominator effect of low fundraising globally, emerging markets account for less than 15% of activity. And that's all a bit wild given the size of these economies, their growth rates, the size and dynamism of their populations, the volumes of consumer expenditures, yada, yada, yada. So what gives in this scenario? Why is this so? This presentation is going to try to answer these questions. And so what I will do is I will start with some definitions so that we know what we mean when we say emerging markets and EM private equity. We'll then dive into a brief history of EMPE. Spoiler alert, we will diagnose what's gone wrong in EMPE, and I'll share some thoughts on the future. Right, so definitions. Okay, so briefly, what are the defining characteristics of emerging markets? And I would just highlight 5. First is that access to financial and human capital is constrained. Though these are large markets, the raw materials for building businesses remain scarce. Second, regulations and political risk are opaque and abundant. Third, information asymmetries continue to exist. Even though it's 2018, it's hard to find quality data and information on companies. And even then, as anyone who's read Mr. China knows well, there are issues around culture that can create challenges for outside investors. Fourth is that there are few intermediaries that are brokering transactions, so origination requires deep networks, and this lack of intermediaries can also prove challenging when it comes to exits. And finally, these are typically fragmented markets, and in many of the more frontier countries, there are still a lot of white spaces or opportunities for roll-ups or buy and build strategies, things of that nature. Okay, so what are the defining characteristics of EM private equity? Here I'll stick to just 4. The first is that growth equity is more prevalent than buyouts. The second is that minority investments are more prevalent than control deals. The third is that value is often derived from organic revenue growth rather than leverage or efficiency gains, which is often just a euphemism for firing people. And finally, given the nascent level of capital market development, the windows for exiting investments can be volatile indeed. Or are they? As a matter of fact, growth equity has gone out of favor and it's being eclipsed by other strategies, such as venture capital, private credit. Minority investments do remain prevalent, but we are seeing a greater frequency of control deals as well as structured deals that provide seniority in the capital stack. Organic growth is still an objective, but we're seeing roll-ups through acquisitions as well as the pursuit of efficiency gains. And volatility is just the name of the game. This is still the case. So in this presentation, when I use the term private equity or PE, I'm focusing on buyout and growth equity funds, not venture or private credit. We'll discuss some of these other strategies toward the end. Okay, so a brief history of EMPE. Now, what I thought I'd do is provide this history of EMPE in 3 stages. Its emergence from the early 1990s to 2000, which was a period of reform and privatization. Its expansion between 2000 and 2009, which was a period of global financialization. And its consolidation from the global financial crisis until today, which has really been a period of crisis and uncertainty. And what we see is that with the collapse of the Berlin Wall in the Soviet Union, the development of private enterprise and market economies in Eastern Europe and the former Soviet states became a principal objective of Western policymakers. There were several initiatives to channel capital into nascent companies, including U.S. Agency for International Development-backed enterprise funds, which took equity positions and extended loans and generally sought to foster the development of local financial sectors. In addition, the European Bank for Reconstruction and Development was created, and over time this institution would become a key investor in private equity funds. In the Western Hemisphere, following the Latin American debt crises, you also had a push from Washington and multilateral institutions for investor-friendly reforms. And these so-called Washington consensus policies of fiscal discipline with market-driven interest rates, the liberalization of trade and investment, and the privatization of state-owned enterprises, or SOEs, opened up a larger swath of the world to international investors. And this period was an era of growing global investment, and private equity funds were no exception. From a volume of $123 million in 1993, private equity funds investing in Latin America grew to several billion dollars per year by the late 1990s, and funds targeting Eastern Europe and the former Soviet states were drawing about $1 billion per year. So what were the defining characteristics of this early period? I will just focus on three. The first was that it used a fly-in, fly-out model. At this time, U.S. and European funds were expanding into these new markets, but they were typically light on local knowledge. The second is that in many instances, the deal makers were replicating the model of buyout funds in the U.S. They were high on investment bankers and financial engineering and low on hands-on value creation skills. To a certain degree, they assumed that the information used for due diligence and financial models would be readily available, and that turned out not to be the case. Some of these deal makers would recount stories of meeting entrepreneurs who were running several sets of books and a high degree of informality. And finally, this was a volatile era for emerging markets with a concatenation of globally systemic financial crises, from Asia through Russia all the way to Latin America. And so what were the results of these early funds? Well, they were downright discouraging. As of the fourth quarter of the year 2000, the pooled return for 1993 to 2000 vintage EM funds was a measly 0.16%. Moreover, a survey of 227 Latin American PE deals that occurred between 1995 and the middle of 2000 indicated that only 15 deals, 7% of the total, had achieved an exit. Well, LPs were fairly disgusted with what they saw, so predictably, they beat feet for the exit. And fundraising cratered for emerging markets. Latin America and Central and Eastern Europe, which were pulling in between $2.5 to $5 billion per year in fundraising, would drop below $1 billion, and indeed, the industry appeared to be dead. And it was at this nadir in 2000 that IFC, the private sector development arm of the World Bank, created a dedicated department to manage investments in private equity funds. Now, knowledge about their private investments was a shambles. As one senior member of the team said, we had $1 billion of investments in 100 funds. We were missing LPAs, subscription agreements, histories on capital calls. And cleaning up this quote-unquote compost heap of documentation took a year, but this decision to create an investment funds department would prove to be crucial for the shape of the industry's growth in the years to come. Similarly, circa 2004, CDC Group plc, which is the UK's development finance institution, or DFI, spun out two of its investment managers, Actis and Oreos Capital, and it became a fund of funds that invested in EM managers, including some of the more renowned local teams today. So, taking a step back, by 2004, two major DFIs had set themselves up to be anchor LPs for the industry. And in addition, Roger Leeds, who was a professor at Johns Hopkins School of Advanced International Studies, had been hosting dinner seminars with a group of early practitioners to discuss some of the challenges of investing in EMPE and really root out why it had been performing so poorly. And so this small group sort of served as the foundation for the creation of EMPIA, the Emerging Markets Private Equity Association, which would serve as a source of data and credible information on the industry and provide a forum as well for investors to share best practices and really try to professionalize and institutionalize this nascent asset class. Okay, so stage two. As you can see at the beginning of the decade, not really. Let's take a look at the returns here and look closely at these numbers. They're extraordinary. These data are as of fourth quarter of 2007, the year that fundraising for emerging markets exploded to $58 billion from $33 billion in 2006 and single digits before then. And again, this exhibit excludes venture capital. Now, the top quartile breakpoint is in bright blue, and it shows net IRRs between 25 and 60%, with the top 5% of the funds shooting the lights out at 130%. And that is not a typo. Now, when I compare the fundraising volumes with the performance figures on this slide, I see a market that cleared. Capital became scarce, creating ample opportunities for alpha once the tide of global liquidity returned. Let's take a look at that fundraising slide again. Again, with those performance figures, it's no surprise why investors dogpiled back into emerging markets. So what were some of the key characteristics of this period of expansion? First, the fly-in, fly-out model went out of favor, and there was an increased appetite for supporting local managers. Boots on the ground became the mantra. Local knowledge, local language, local culture, all of these were believed to be essential for better access to information, better origination, etc. And the DFIs, including but not limited to IFC and CDC, played a key role in this. They really sought to foster the development of local managers and local capacity. Second, there was an explosion of new entrants coming into the market. This includes a bevy of spinouts from existing firms, especially in India. You saw lots of frustrated junior deal makers who were missing out on these copious volumes of carry, and by gum, they were going to get their hands on it. And to give a sense of the volume of players in 2008, 170 EMPE funds closed, 40 buyout, and 130 growth equity managers. And finally, there's no denying that herd behavior was on display. The avalanche of capital and the explosion in fund managers not only meant that there was arguably too much capital chasing too few deals, but perhaps too many LPs seeding too many managers as well. And then the music stopped. And not surprisingly, fundraising for emerging markets private equity craters after the crisis. But it does rebound, albeit a bit slowly. Emerging markets during this period take over as the engine of the global economy. Some of the fund managers start talking about these as quote-unquote growth markets. At the time, we've got unprecedented easy liquidity conditions in developed markets. China embarked upon a massive expansion in credit. Moving forward to 2013, we did see the taper tantrum and saw a confluence of a strong dollar, collapsing commodity prices, and a slowdown in China, all of which hit sentiment toward emerging markets, and this really only began to recover in earnest within the last year or so. But taking a step back, the fundraising figures never hit the high water marks of the pre-crisis years, and they've generally flatlined since 2011. In fact, from 2011 to 2016, the volume of fundraising declined by 25%. Now, 2017 shows a rebound here, but it's misleading. KKR Asia 3 is $9.3 billion of this, while Affinity Asia closed on $6 billion. So those two Asia-focused buyout funds are 40% of the private equity capital raised in 2017. Now, if you exclude those two, there's only $20 billion in the market. And that's peanuts. So what's going on here? Can one divine meaningful insights from this top-line analysis, or do we need to probe a little bit deeper? We're going to do a little bit deeper. So the first thing that I'd like to focus on is that LPs have lost their appetite for the traditional strategy of EMPE, which is growth equity. We see a 44% decline in the number of growth equity funds achieving a close since 2010, and the trend is fairly linear here. Buyout is pretty steady, which suggests to me that the strategy has a fairly stable pool of managers that LPs are willing to back. But notably, the number of EM buyout funds achieving a close isn't growing. The second thing I'd highlight is that capital concentrates in fewer, larger funds. This chart plots the volume of capital raised by funds greater than or equal to $1 billion, which is the size of the bubble, their percent of the total amount of private equity and venture capital raised in a given year, which is the y-axis, and the number of funds, which is the row of digits beneath the x-axis. And what it shows is that a handful of funds account for the bulk of the fundraising. And I literally mean a handful. 5 funds accounted for half of the capital last year, and in most of these years we see a single-digit number of funds accounting for between 1/3 to 1/2 of the capital. Third, we're seeing fewer new firms entering the market. This chart is from MPIA's latest batch of industry statistics, and it shows that first-time growth equity funds have declined from about 30% of the total capital raised in 2008 to 2009 to less than 10% over the last 4 years. And finally, the DFIs have been walking away from these first-time funds, as exhibited in the bright blue line on the far left, and they're investing in more established managers. So the DFIs, which 15 years ago or so began an earnest attempt to seed local private equity teams, are transitioning towards supporting larger, more established platforms. IFC, for example, has been investing in the Carlyle Group's funds. And to me, this suggests that a structural shift is at play in emerging markets private equity. The biggest buyers of the product are less willing to back new teams. And in my less generous moments, it does smell a bit of the whiff of corporate welfare for larger established firms. So what explains this declining number of funds? Once again, let's look at the performance. And the stark reality is that GPs have not distributed capital. Look here at the drop-off in 2007 when fundraising exploded. It's 10 years later, and the top 5% of funds from that vintage haven't doubled investors' money. And what's worse, the top quartile breakpoint beginning in 2008 hasn't even returned investors' capital. Performance has been terrible. It's been a lost decade. And what exacerbates this is the long tail of private equity as an asset class, with capital just sitting in assets and fees being paid to managers, and it's all just trapped. It can't be recycled to GPs with promising strategies. And what do we see? Once again, investors are walking away from EMPE. So each year, MPIA surveys about 100 to 120 LPs that have been active in emerging markets private equity, and the percentage of LPs expecting at least 16% net from their EMPE portfolios has continuously declined over the last 5 years, from 72% in 2012 to 43% in 2017. And 2017 was the first year that this figure dropped below 50%. What's worse is the number of LPs decreasing their allocations to EMPE is going up to nearly 1 in 4. And notably, this figure jumps to 36% for LPs that have been active in EMPE for 15 years or more. Behold the desiccated, barren landscape of emerging markets private equity. The markets needed to clear, we've needed to get rid of the dead wood, but it hasn't happened, at least not quickly enough. Okay, so what's gone wrong here? Was it all just a bubble? Here we have Jean-Paul Rodriguez's classic stages of a bubble and EMPE fundraising. Or was there a genuine opportunity here? I won't belabor the case for emerging markets private equity, but just a few charts. First, we see that emerging markets constitute nearly 60% of global GDP. There's rapid consumption growth in emerging markets, and there are large volumes of it. Local companies are often better able to access this growth and frequently grow more rapidly than their publicly listed peers. Small and mid-sized businesses in emerging markets confront a persistent financing gap. 9 million formal SMEs have unmet financing needs. That totals about $4.5 trillion across the emerging markets. And so what happened? If this opportunity is so great, why did it fail to materialize? One reason is that too much capital flooded in too quickly. Between 2001 and 2004, emerging market fund managers raised $22 billion in capital. Between 2005 to 2008, that number exploded to $171 billion. There was nearly 8 times the volume of capital looking for deals within a 4-year period. All of that capital couldn't be invested well. We saw lots of poor deals being done and managers exhibiting style drift to put that capital to work. Another reason was that, in addition to the volumes of capital, LPs were herding into hot markets at the wrong time. For example, Brazil was the darling market in 2011. It was the #1 most attractive market in MPIA's LP survey. The stock market and the local currency were at or near all-time highs, and LPs went big into a handful of funds. Africa was a similar story between 2013 to 2015, when it became one of the most attractive markets. And investors flooded in, committing to several large-cap funds of the same vintage and a geography with very limited large-cap deal flow. So you see 2 problems. The first is investors buying into a geography as sentiment is peak bullish and markets are about to turn. And the second is the concentration of capital in larger segments of the same vintage, putting upward pressure on entry prices. So after everyone got bulled up on emerging markets, how many stayed bulled up with the firms they partnered with? The answer is not most. We ran an analysis on this, and less than half of the GPs that raised capital between 2005 to 2009 were able to raise a follow-on fund. This suggests that the quality of the managers was not up to snuff. And that's something we verified in our own survey last year called the Mid-Market Squeeze, which is freely available on our website. Maybe, in a world where capital flows were more measured, these managers would have done better. But in this best of all possible worlds in which we live, that proved not to be the case. Now, to be fair, the industry was at a nascent stage of development. GPs could do a great deal or two, but they had challenges constructing a portfolio. And frankly, it is fair to expect some growing pains. But commercial investors can be less forgiving. As one LP put it, the teams have been heavy on investment bankers who don't know how to do deals. In emerging markets, private equity is the dumb money. And finally, there are limits to the absorptive capacity of emerging markets private equity. Now, this is taken from a piece that we put out late last year, which is also available for free on our website. But in this piece, we followed a thought experiment from Fred Wilson of Union Square Ventures. We took the average fundraising volume between 2005 to 2017, which was $35 billion. We then set a target gross multiple of 3x, which is what LPs historically have said they're looking for in EMPE, even though it's preposterous. And that got us to $105 billion in required exits per year. Well, what have exits been? Not $105 billion. Not even close. And believe it or not, this picture is worse than it actually appears. So Impea's fundraising statistics, which I've used for this presentation, don't include funds with global mandates that are investing in emerging market deals, such as Warburg Pincus's flagship vehicles. Now, according to Thomson Reuters, which is the source for these exit data, Warburg generated approximately $3 billion in emerging market exits last year, or nearly 7% of the total. Now, all of this is to suggest that, one, the fundraising figures from Impea understate the volume of exits required from emerging market companies, and two, the exit figures shown here give a more favorable view of EM-dedicated funds' ability to generate exits than is the reality. Okay. So that's our look in the rear view. It gives a sense to how we got to where we are today, which candidly is a place of disappointing returns and a lot of soul searching. Admittedly, it's a very bearish view. I've probably been disinvited from a few cocktail parties for putting out some of these ideas. But when it comes to the future, I'm a bit more optimistic. Not for the industry as such, but for investors' chance to invest with quality managers in very exciting markets. Okay, so thoughts on the future. The first point I'd make is that I think the traditional emerging market private equity model, the growth equity funds, are in structural decline. And I'd say this for several reasons. First is that commercial LPs are voting with their feet, as are the DFIs. I think we're going to see a smaller universe of players in this space, as well as less capital available for the strategy. And my argument is that this is okay. A shakeout needed to happen. The market needed to clear. The problem is that there was so much capital that went into these markets that it's taken a lot longer than it should have. But I do think we're approaching the bottom. If, and this is a bit of a big if the EM bull market continues in public markets, then the exit window should open and GPs should start distributing cash back to their LPs, which can then be recycled to new commitments, and we may be hitting the floor. New managers are coming to market with strategies that are better aligned with their investable markets, from the sourcing of investment opportunities, whether those are brownfield or greenfield, to their value creation strategies, as well as through their approaches to deal structuring and exits. GPs that have managed to survive the recent period of crisis and consolidation may offer a genuinely differentiated product. And finally, the main lesson from previous cycles is that less capital creates opportunities for higher returns. And the charts in this presentation tell us that the sub $1 billion segment has been hammered and that there are fewer and fewer players operating here. That's generally constructive from my view. All of which is to suggest that now is a good time to go shopping for managers. point two is that LPs are recalibrating their exposure to emerging markets, and it's really taking on a bit of a barbell approach with respect to risk. On the one hand, there's a lot of enthusiasm for venture capital, with the number of venture capital funds achieving a close really rocketing up, and these are highlighted in orange on this exhibit here. And with the number of funds increasing, we're also seeing that fundraising for the strategy is going gangbusters. On the other end of the barbell, LPs are seeking greater security through positions higher in the capital stack and with structured deals that provide yield. As a result, we're seeing private credit grow as a strategy, but it's at a more measured pace than venture capital. But I think that LPs should be more creative. There's a multiplicity of ways to access investment opportunities in emerging markets, and I would argue that products that fit neatly within rigid asset allocation buckets may not be the right fit for EM. And this is exciting. We're seeing a richer, more diverse investment landscape, and it's one that I believe is better aligned with the universe of investable companies in these markets. Finally, I think it's important to ask if past performance is a reliable indicator. Academic literature in the US suggests that it's becoming less relevant, and emerging markets are transitioning very rapidly, which does make me wonder if persistence might be even less relevant for EM. Technology is disrupting everything, and emerging market consumers are early adopters. This creates additional challenges for assessing whether past performance in other sectors will continue. In addition, there's just been an explosion in wealth creation over the last decade in emerging markets. There are a lot of deep-pocketed local investors with lower return hurdles that creates competition for deals. And it can also raise the pricing expectations of local entrepreneurs. So this can make for a more difficult environment, even for proven GPs. Finally, take a closer look at performance benchmarks and question whether they're worthy benchmarks. So I've relied on Cambridge Associates data for this presentation, but if you compare the number of funds in Cambridge's data set to the universe of funds that MPIA tracks, it's between 5% and 20% of the total when measured by count, which is the left-hand chart here, and between 30% and 60% by capitalization, which is the right-hand chart. Now, I know many established managers that refuse to provide their performance figures to Cambridge. And in fact, one global manager was befuddled when I shared some of these performance figures, and they noted that their EM deals are generating IRRs well north of 30%. So it does pay to do your own work here. All of which is to say that the great performance that we may have seen during previous eras may not be a reliable guide to the future, and so too, the poor aggregate returns of recent vintages may mask genuine opportunity. Emerging markets are complex. They require seasoned and sophisticated navigation skills, but therein lies a genuine opportunity. So, in conclusion, emerging markets private equity has been going through growing pains. The pro-cyclical behavior of LPs is a very real part of the problem. Capital's concentrating in fewer, larger funds, and particularly in Asia, which means that there's a scarcity of capital for investors targeting the mid-market, which is also where there are many, many more deals to be had. In addition, compelling macro dynamics don't make you money, managers do. So choosing your partners wisely is absolutely crucial. And finally, the opportunity set in emerging markets defies rigid asset allocation frameworks. It pays to be nimble and to do your own work. Okay, so thanks for listening. If you'd like to learn more, I heartily recommend Roger Leeds' book, Private Equity Investing in Emerging Markets. MPIA, LAFCA, and Asia Private Equity Review are useful for data and qualitative insights on market developments. And of course, our website, porticoadvisors.com, offers some free research and a free monthly-ish newsletter. Thanks again for listening. Take care.